Today, we're going to talk a little bit about seller financing. How many here, besides the folks on the panel, have done a seller financing deal? So good. We have a lot of folks, a lot of hands. That's awesome. Today, we'll talk about some of the pitfalls. Those of you who are in our viewing audience, if you would also please make sure to, bring up your questions and share some of your ideas. Shoni gave me questions. He said they're primed and ready to go. So the first one was, what challenge did you resolve? What challenge did you resolve using seller financing?
So in my case, we sold the building lot for more than it was worth. We had been on the market for quite a long time, and we got an offer for about $50,000 less. And we countered with seller financing for $50,000 more, and my client made more than it was worth.
Client was super motivated as far as timing. It had been on the market by another agent, so timing was of the essence. And we essentially were on the market and closed in 28 days.
Is there a challenge?
Yeah. Challenge.
Well, my challenge, one of my seller financing deals, there were 4 owners to it. And so when I educated one owner and we changed terms on the MLS, and then 2 days later, an agent reached out, and then we had an offer for seller financing to close in 2 weeks. One was all on board, the other one had no clue. So the challenge was, one had to talk to a real estate attorney to understand it, even as I educate it. Our net sheet is a very great tool to go through those objections. And we did, everyone ended up getting on the same page and closed 2 weeks after our offer.
So the big challenge was being able to move on to their new home. We put theirs on the market for 3 months with like hardly any activity at all. I got a wholesaler that reached out to me and put that under contract, and then he canceled the day of closing, which sucked. But then I changed the price, increased the price, and begged a lot of people in the office, cough, cough, Becca. She was able to get a buyer and be closed within 35 hours, which was awesome.
Only 35 hours.
Only 35 hours.
You guys hear me okay? Yeah, kind of. Oh, great.
And then the other
Keep going.
challenge was being able to get them to have a down payment and pay off their consumer debt in order to qualify for the next purchase. So.
Yeah.
On the other side of that, Becca, what motivated your client to buy it?
So repeat the question if you would.
So the question was, what motivated my client to buy it? So my client is an investor who has 2 jobs in California where he makes good money, but they haven't been on his tax return long enough to qualify traditionally. So he's very motivated to buy stuff. He just has to be creative in how he does it. So that worked out. I mean, we negotiated for like 3 days. Like, it sounds sexy, it was 35 hours, but like we negotiated back and forth for 3 days to find.
He does buy. That's why I didn't sit next to her. She's a great negotiator.
Good.
Yeah. So there was a lot of back and forth, but we made it work out for everyone.
Perfect. Jake, you have pictures. Show us what you got.
I just outlined what the deal was. Do you want me to do that?
Yeah, do.
Okay, so we did a lease option to contract for deed. And the reason for that was because, did anyone go to Jax's class this week? Does anybody know why I did that? Cameron?
Jackson's class.
Oh, okay.
I know why. I'm on Zoom.
Okay, go ahead.
So they needed to be able to buy a home. And if you do a lease option in the beginning, then it doesn't show against the lending process, so that they were able to get the financing for the home that they're going into. And then you can turn around and change it into the other.
Exactly. So with a lease option, it falls under the lease category. So rents received, the banks will recognize that. If it is on contract for deed, it is a note category, and that income is not recognized for a whole entire year. So the wording on this addendum for seller financing, hold on, was: this sale shall begin as a lease option, and the contract for deed shall be dormant for a period of 12 months or until, this is written by an attorney, for a period of 12 months or until sellers complete financing of their subsequent property purchase, after which the contract shall become active and the loan or the lease option shall terminate. The $70,000 from buyer shall be considered option consideration during the lease option period, and shall be credit towards the contract once the lease option terminates.
Okay, so just to clarify something in my mind, on the sales side, when seller accepts seller finance, it's more favorable for the seller in order to get finance to do a lease option initially.
Exactly. That's why it's a lease option to a contract for
Can you
deed.
restate his statement or question? Because I'm just
Yeah.
reminding you without a mic, we can't
Thank
hear
you.
him.
Okay, so what he's saying is that the lease option is what we need to do in order for the seller to qualify for the next property. So that's the reason why we did lease option to contract for deed. We listed it initially at like 425 and it sat on the market. We kept reducing the price till the comps were selling at around 385. We weren't going anywhere. So I actually increased the purchase price, put all the terms in the MLS and waited for like a couple of hours before I had a couple of showings and begged Becca to bring her investor to the table. And we were under contract pretty soon after. So we asked for 70K down. I think I initially put 475 in the notes or something like that. Something like that. She came at me with like 4%, guys. No, that wasn't going to work. But the reason why it wasn't going to work was because of their underlying mortgage. So this is the underlying mortgage, the principal and interest, mortgage insurance 1693. And we finally resolved at a 4.6 with a 30-year amortization, a 7-year balloon. And then if you add up their payment here is 2,047. The HOA and taxes are always buyer paid no matter what they end up being over time. And then this is the underlying mortgage, 1770 minus 1693 is their cash flow per se, is the check that they get written from the escrow company that pays all the bills each month. So Becca became champion in this because her investor's actually getting more of a cash flow than my buyers are, because he's rented this for or what was it, 2275.
Yeah.
So yeah, so that's pretty awesome. So win-win, because we were able to get a higher purchase price. His payment is more affordable, and they were able to move on to their next property. My sister was going to have a baby. It was my sister, and they were having another baby and needed more space, and baby was born last week. So everyone's happy.
Oh, that's fantastic.
How many other agents bring in?
So I had 2 other agents that wanted to bring offers, but I said, look, they were just canceled on at the closing table. I need $10,000 earnest money, non-refundable by tomorrow if you want this, because that's what my sellers were like. We don't want to be ditched out on again. So they're like, okay, we don't want to do that. So then we went forward with Becca because time was of the essence. We needed to close the other property that was finished. It was new construction. We had a really low interest rate locked in at like 4.5 and needed to close on that. So.
Wow, awesome. Thank you so much. Other questions before we move on?
I was gonna say, my client also did cost segregation on the property, so he could offset more taxes. So his cash flow wasn't his primary goal, like cash flow is great, but he needs to offset taxes because of his tax bracket.
Okay, so there's some other advantages. So talk really quickly, what are some of the risks that are involved in seller financing that you guys have worked on and what are some of the tools you had to use to mitigate some of the risks?
Well, I think a really great conversation is really important. So, well, first of all, using an attorney to help you to make sure all your boxes are checked, but saying, hey, seller, you need to make sure you have X number of dollars in the bank account in case they default. But at the same time, that could be you winning the lottery because you get to keep their down payment and then get another buyer to give you another $70,000. So if Becca's buyer says, hey, I don't want to pay you anymore, we're like, okay, fine, we'll put it on the market again and foreclose on them and get another 70 grand from somebody else.
What does that foreclosure look like? What's the time frame?
It depends on the type of seller financing. So, and Cody will help me out here or whoever else. I know that you've talked a lot about this.
Yeah,
Contract for deed is like 96.
Yeah, your contract for deed, you're about anywhere from a couple
36.
months to as much as maybe 6 months, where you're all inclusive. You're going to be probably a 9 to 12 month process. It is more expensive. You're going to pay more in attorney fees to try to go through that, because all inclusive, they are on title at the county level, and so you've got to remove them from there. Contract for deed, both parties have signed, but if they don't fulfill the note, the buyer doesn't, then it's a lot easier process, a lot cheaper process to take the property back
And
at
that's
that point.
because the seller's on title.
Yeah, because seller has maintained, ownership on title.
Yeah. The easy analogy is if you think of when you purchase a car and you're doing it with financing, the bank actually holds title to the vehicle, even though you're the owner of the vehicle. In this case, owners of the home still are making payments until that contract is fulfilled, and then they would be put on, and they'd be put on
Correct.
title.
So it was really cool. Well, not really cool, but when that first buyer canceled on us at the table, we took their earnest money, and I said, "I don't trust you with this. Give me the money. This is my sister." She had like 30K in credit card debt, and so I'm like, okay, if someone for like defaults on their payments, you need to have some savings. So I took it from her.
I don't recommend that. Or that.
I checked for seller financing on the MLS and I don't think I saw anything last week. I'm assuming these things are going very quickly. It's like, you don't want to wait 60 days. 50 days on the market for your listing. This is the way to get rid of it.
Yep. Yeah. As far as the data, I've tracked the data the last 6 months. We hover around 3% of listings right now. The past 6 months offer seller financing. So today there's 6,592 active homes on the market and only 208 actually offer seller financing. So when you look to take a listing, as far as marketing purposes, how do you market a home in such a way that nobody else is? Seller financing is a way to put together terms. So as a team, we have every listing appointment we take as a team, we do discuss seller financing. Now, not every seller is open to that. The next landing place may not fit ideally, but it is a conversation that I would recommend you guys having is, hey, have you considered seller financing? Because that simple percentage, like only 3% of homes right now offer this. So how do we market your home in a way that nobody else is? Seller financing.
Great.
You mentioned the lease option as a way to help the client go forward with a new purchase. So what about, what are our other snags that could hinder them if they accept seller finance to not be able to qualify for a mortgage when they move?
Want to repeat the question?
Becca?
So how does it
Bianca?
affect them qualifying for a loan?
Yeah, there's a couple of dynamics you've got to navigate. So the question is, what other things should we be aware of when we look to take an offer, seller financing offer, if we have a listing? Getting really clear on the next spot for the seller is really important. So to understand if they are looking to qualify for this next home, one, you either have to do a lease option to start, or they have to know that it's 12 months of consecutive payments in that seller financing deal before they're going to be able to offset that debt. So if they make tons of money and they're not worried about their DTI on the next mortgage, you'll be fine just to go out the gates and do a contract for deed or all inclusive. Now, if they need to get the DTI down, so they need to offset that mortgage payment they currently have, you're going to have to start with the lease option.
Did I answer your question, Graydon?
Yeah. Okay, so this is the question from Shoni. It says, how did you identify that seller financing was a potential solution for your client? You said you talk with, on all of your deals, you said you actually bring up seller financing with your client, with your seller.
Yeah, we've got, as a team, we've built out, we've kind of taken, if you were at Jax's class, he's got his spreadsheet. As a team, we've taken that and changed it quite a bit. So we've got it broken down to where we can essentially identify how much money my seller is going to get at the close table. So after commissions and closing costs are paid, how much they'll net in their pocket, how much the monthly cash flow will be, and then what their balloon payment will be, depending on the terms that are negotiated there. So for my specific deal, the reason why it was beneficial is they had about $158,000 in equity in their home if they were going to sell traditionally. And so they had already bought a new home. They had 2 mortgage payments. They were super concerned about, how they financially were going to be able to make both payments. So looking at seller financing, they were looking to sell the property, recast that new mortgage, and get their payment down to about $3,200. Okay, that was their goal in doing this. So seller financing, we were able to close it out in 28 days, which timing was of the essence. They essentially netted $31,000 at closing. And then the monthly cash flow was $821. Their mortgage payment on the new home was $4,000. So the monthly cash flow, because they had such a low interest rate, they were actually the same amount per month on their new property, having the seller financing deal as they would to recast the mortgage. So for them, it was financially beneficial. It still put them in the same position it normally would. But the huge benefit is if they were to sell traditionally, they essentially would have netted 158. This is a 4-year balloon on the seller financing deal. And so they end up netting $51,895 extra over a 4-year period. So they end up netting $210,000
Oh, that's
by doing
awesome.
seller financing.
That's
So
awesome. Choquel, question?
We have a question on Zoom.
Yep, go ahead.
So it's from Russ. He says, can the buyer sell the property during the term as long as he makes good on the balloon payment?
Yes.
And the answer is yes.
Okay,
Buyer
that's what I
can
thought.
sell anytime before the balloon payment is finished.
Right.
There may or may not be a prepayment penalty, but that's just specified. You guys negotiate that.
Right, it depends on how the contract's written, correct?
Yep.
Correct.
Thank you.
All right. So Choquel, you mentioned you used a net sheet to really help your sellers understand. Can you kind of describe your net sheet? What are some of the main points you guys?
It's
Wonderful.
like this one. So I did a deal in Sandy. We listed it for 580K. I educated my seller at the listing appointment. Within 36 hours, we got 4 offers. We had 3 cash, 1 at 500, 1 at 520, and 1 at 530. And we had a full price seller financing offer at 580 with 100,000 down with 5% interest rate. So of course we took that one. His underlying mortgage, he owed 320 on it. His payment was roughly 1,800 a month. And she was going to pay over 2,500 a month. So with that payment that she pays escrow services on the 1st, like on the 5th, it pays the underlying mortgage to protect the buyer, but then it spits out the interest to the seller. And our term is only 12 months. And so he just didn't get the 580, but after the 12 months, so in interest, he'll make over 600,000 on the property.
Wow, that's
So
awesome.
I do have that all in here too.
Okay,
It's on my computer.
it's on your computer. Yeah, Graydon.
Question about lease option again. That's to protect the seller, to help the seller buy a new one. But when do the agents get paid?
At closing, like a
So-
normal,
Question was, when do the agents get paid
Yeah.
on lease option to contract for deed? So as you remember, the lease or the contract for deed, well, it will the lease option terminates once they are qualified for and then complete the purchase on the subsequent financial buy. But that has nothing to do with getting paid, right? You can just put that in the MLS, and once the closing happens, is the title company will send the check.
Right, so in essence, from the proceeds of the down,
Right, exactly.
that's where the commissions are paid. So they're paid
Yep.
at the closing of the lease option.
Yep.
And then there's just it's a technical term where they actually move it.
You can specify
And you
that.
can specify a time. That's all about escrow instructions
Yep,
and commission instructions.
You
Rob,
take a commission on the lease.
you can. Yeah. So that's what we were just saying, is that you can specify that as part of the lease option money. Or you can say, okay, well, you don't have, it doesn't always have $70,000 down on a lease option, right? If they can't make it work with the numbers, you can choose to get paid whenever that lease option is done.
right. So lease options in general, if we're doing just a lease option alone, usually that might be 5, 10, 20,000 down.
Right. Yep.
Whereas seller financing, you really need to have that rough, 5, 10%
Right.
down and beyond.
Yep.
What other terms, what other things, what other landmines should we be looking for?
I mean, thou shalt not do all-inclusive with an FHA loan, correct?
yeah, at all.
Thou shalt not, you will be put on a list and you will not be able to do an FHA loan for how long? Forever? Is that?
And that could affect the whole brokerage, so you would be
Right.
fired.
So thou shalt not do that.
That again.
Thou shalt not do all-inclusive deed and trust type of seller financing for FHA loans. You
Okay.
can do contract for deed.
Yeah,
FHA.
Rob,
No.
You ever have difficulty finding title companies that don't, that aren't?
Yeah. Yep. It's tough. They're all, they don't all touch it.
Who does? Who do you guys recommend using?
So who do you recommend for title?
So I
I mean,
personally,
obviously, Jax's company will do it.
yeah,
Is it
Jack Spetty,
Liberty?
he came and did a class.
Yeah, First Liberty.
Mhm.
Just knows his stuff.
Yep, this is his niche.
And
Yep.
I've used Justin Sutherland. He owns the title company and his dad owned it before, so he's very
Under
seasoned.
title. Okay.
Uh-huh.
Yep.
Yeah, Burgundy can do it. Real
Yeah,
Advantage can do it.
Real Advantage Title Company is also available. And then, yeah,
I'm sorry, but you do know that there's a due on sale clause on every conventional loan.
Yep.
Talked about that?
ask away.
Yeah, I mean, that's a risk to the seller.
Absolutely.
Start happening and they start being weird about stuff and they can come and call those note due and then what do you do?
So the due on sale clause is in all of our listing agreements, like everyone you sign. So it kind of covers you from that, but you just have to explain it to your client that it is a possibility. Every loan has one and have an exit strategy. But really the burden is on the buyer in that case, because the buyer has to figure out how to pay the seller off to get that note gone. So they can either sell the property, refinance it, but that is a risk to both your clients on that. And talking to others who do a lot of it, they said they've seen it called like 3 times in their hundreds of transactions.
Yeah, the one that you're going to be very, very toe lightly is a Utah housing loan. So
Yeah.
I would tread very lightly. Dean's shaking his head. Don't
Don't do
get
it.
fired. Don't do it.
Yeah.
Don't do it.
The contract for deed, since you're still on the title, most of the banks don't worry about it.
Well, that's the loophole, but there's still risk because if you change your insurance, they know. If you change your HOA, they know. If you change your address where stuff goes, they find out. So there's loopholes, but
Can
You
you
can-
repeat what
they'll
they,
find out.
what you're answering?
Yes, he was asking, contract for deed should avoid the due on sale clause because they don't transfer title. So yes, but they also can find out if you moved out or not.
There's also if you show a history that you've been making payments, for a year or two, it's really difficult for the bank to call it because they've been accepting payments.
Well, correct. I think that's the due on sale clause is there. But again, if somebody is making the payment to the bank, the way everything's set up electronic now, I mean, if you're making payment, the likelihood that a bank comes back, starts sending you your money back and says, I don't want your money because I'm calling the due on sale clause. I'm going to enact this clause. Again, that's where the chance of that, as long as the payment's being made, there still is risk there. You still have to have an exit strategy, disclose. I think if anything with seller financing, making sure that everybody on both sides of the table is aware of the risks involved and making sure that we are educating. If you're going to go down this road, ask lots of questions, reach out, make sure you're educated, make sure you're having the tough conversations now. So Dean's not having you in his office later on.
I have a nice office, just saying. So if you had to pick what's your one takeaway from doing seller financing? And you'd say, I want to do more, I want to do fewer. What are your thoughts?
So my client will only seller finance from now on. He's like, when I sell my house, that's what I'm doing because he loves the interest rate money that he's going to make from it. So that'd be my big takeaway is once you properly educate someone in it, they understand it and they have that mindset, you could get multiple transactions where before it might have been one every couple of years.
Okay.
I think for me, it's bridging some of the hardship that we have in the market right now, whether on the sell side or the buy side. Okay. So for buyers, investors, obviously we are all aware nothing cash flows right now in this market if you're getting a normal conventional investor loan. So seller financing is a great way to still get people in investing because you can cost seg like Becca's example there and still cash flow potentially by doing creative financing. The other thing for some sellers too, they may have bought towards the peak. They may owe, a certain amount where they can't get out right now. But seller financing, there is a way to run the numbers for them to still move on and make money on the property that they bought. And so it's a way to bridge it. And the other one too is you've got old landlords or people that are sick and tired of being landlords. Seller financing, you want to make money every month and not have to worry about the furnace going out or the roof leaking. Like this is another great way to capture and go do deals. So seller financing in this market, as sales have been down, seller financing is a way to go out and take more market share and do more deals as an agent.
Sure, because you're no longer a landlord, they're an owner and
Mhm.
welcome to home ownership.
Yeah.
kind of a
Correct.
scenario.
Yeah, you refi it at 2.5 or
You're just
3%.
the bank.
And you
I
just
just
want to be
want-
the bank and you go lend on a 5.5 or 6% rate for an investor right now, cash my check every month. Let's just take it to the bank and I don't have to worry about the tenants. I'm not collecting rent. Just have escrow specialists send me my check every month.
Great. Raquel.
Well, I personally have enjoyed seller financing so far. I feel it gives buyers a lot more opportunities because I've seen they have 10, 20% down and they have a monthly income and great credit, but they can't afford that their payment to be double than what they thought they could get it for. So doing this, it's a win-win for both sellers and buyers because sellers are being the bank instead of the bank and created that interest. And then the buyers actually thinking they're getting in a home and they're thankful and they're putting enough money in, but it's like a real house. It's a real transaction. So they don't want to default on their payments.
Sure. Plus they
Yeah.
put enough down that they have
Yeah.
skin in the game.
They have skin in the
Yeah.
game, so they're more serious. And so that 100,000 down, you have skin in the game. I mean, if they default even a few months, there's this 100,000 down, a couple month payment and his house back.
Yeah.
But they were blessed to get a 5% interest because being the investment, they bought it for that. They would have had a higher down payment and a way higher interest.
Sure.
So
Jake, let me ask you a hard question. You talked about your client's house that you just did. What kind of an interest rate was the underlying mortgage?
2.8 something.
So something under 3. And what was the interest rate that they're getting paid by the new client? What are they collecting?
4.6.
Okay.
Yep.
And it's still a win because what we're finding is right now is roughly 2/3 of all mortgages in Utah are between under 4%. And so this may be another tool. Again, doesn't say it's everyone, but it's another tool to be able to get folks into a house.
Yeah, I mean, there's a solution for every situation. I think my biggest takeaway with this is don't be a victim of whatever's happening in the market. There's always a pro and a con, but also there's a solution to, make it work. And how many times have you guys heard, oh yeah, I'd buy this or whatever, or I don't want to sell because I have this interest rate, or I want to wait until the rates go down. It's like, well, just negotiate that.
Yeah,
Make it work.
that's great. Graydon.
Yes, out of all your seller finance deals, panel,
I've only done one,
what
just so you know.
was percentage down and total dollar amount to the buyer?
Question is what percent down and what,
And how much money did they bring to the table?
how much
much
they bring to the
cash?
table, how much cash. Mine was 70K down. Good job.
Mine was
16%.
$100,000 for the 580K. And another one was for my $750,000 Moab one. They had no underlying mortgage and they brought only like 8.6% with 4.5 interest rate a month. So they'll make $3,100 a month over for 7 years on interest
Plus a balloon.
plus the balloon. Yes.
I think it ranges. It's pretty common. 10 to 20% is pretty common for down payment. You can find stuff under that. There's for sure stuff that's lower than 10%, but usually when you get to that 10%, that's kind of the sweet spot. If you can get a seller financing deal with 10% down right now, that's a sweet deal. So most stuff that I've done is range anywhere from about 10 to 15% is what we've taken. So
I was gonna say, less than 10%, you got, the seller still got his paid in commission, closing costs, anything, below 10%, they're walking away with hardly anything.
correct. Yeah, if you take less, what he's saying is you take less than 10%, you've got title fees, you still have the real estate fees, the commissions on both sides of the table. So you run into closing costs, you run into a situation where, no loan closing costs, but your title fees and agent fees can add up. That's roughly almost 7%. So if you're down below 10, gosh, the seller has got to have some other motivation. He's got to have a higher rate where he's making more monthly cash flow. There's got to be some other terms in there that make it attractive for both parties.
Sometimes they first look at this like, well, wait a minute, this should have been an all-inclusive trust deed, and that's a lot of money for somebody to lose by default.
Yep.
When I was the listing agent, we were 17% is what we required down. So my client walked with like 50,000 on top of paying everything off.
Great. Any more questions?
What is cost segregation?
Accelerated
Whole
depreciation.
class. So cost segregation is when you naturally can depreciate a building for or a rental property for 27 and a half years. Cost segregation forces that timeline up because some things won't last that long, like your carpet or your light fixtures. So you pay a company to come in and analyze the property, verify what's you can shorten the time frame on, and then you get to write that dollar amount off. Keep in mind, as a real estate professional, you can write it off against your real estate income, but as a W-2 employee, you cannot write it off against your active income. So it's trickier to advise to people who are not real estate professionals.
So stay in your lane. Okay. Make sure.
Was that a okay explanation?
Yeah, that was good. That was good in a nutshell.
All right. Let's give you guys a hand. We're going to finish up a little bit early, but thank you for being here.